Well, Asia has been held back by recent policy moves by the Chinese government trying to rein in capitalism, more or less, in China and put more government controls on many of the new sectors that are emerging. But even so, it's the companies actually haven't stopped growing. The demand for their products outside of the China zone and the other Asia zones remains very, very high. So it's a period of volatility. It's one of the reasons Asia's fallen behind. But I think it's exactly that, a period. Over time, these policies will be absorbed and digested. My attitude is to just to hold the Alibabas of the world and the Tencents during this period of volatility, which I've done. But Europe and the U.S. are the beneficiaries of very accommodative policy by regulators, by the Fed, and continue to be so. I mean, the Jackson Hole Conference really sets the tone globally for how accommodative governments are going to be. The tightening that's being contemplated in the U.S. market and the Fed changing its policy is not likely to happen until early next year. And even so, is going to be done in a way that keeps a mindful eye on what's going on with Delta. So Delta is ripping through the U.S. economy, primarily through people that are not vaccinated and probably won't get vaccinated. So we're going to be having to live with a new form of work behavior and gathering, just like we do with the flu. Microsoft just announced they're indefinitely postponing returning to the office. So all of these changes are going through the economy. But because of the very accommodative policies in Europe and Asia ex-China and North America, equities are still, in my view, my personal opinion, a better place to deploy capital than other asset classes, particularly fixed income. And so when the tapering ends and then you start seeing rate hikes, you don't want to be necessarily long duration fixed income. And that's contemplated sometime next year. But at the same time, you've got the Fed policy really keeping an eye on employment, COVID, the change of the economy, the new digital America, the new digital Europe, the new digital Asia. It's a really interesting time to be an investor, but it's a stay the course time because, if you're trying to beat inflation, which is just over 2% right now, equities seem to be a better choice. And I'm not saying there won't be corrections and volatility, but on asset allocation, which is the core of what we're talking about, I favor equities over fixed income for the next 2 years.